Anne-Marie Birkill's partner at OneVentures, a venture based here in Australia, currently raising their second fund. News article script I saw the other day. But Anne-Marie personally has quite a strong background ranging from a number of areas: entrepreneurship, technology transfer, technology-based startup company incubation, now over the last few years in venture capital. So I guess this is another piece of the puzzle, and John introduced it quite well in terms of the forms of support, particularly financial support that can come into grow ventures and take them to the next level. So I think it seems to have loaded correctly now. So I'll allow Anne-Marie to talk in much more detail. I'll give a round of applause to welcome Anne-Marie.
I might be a technology investor, but I'm going to avoid the technology because it will trip me up. Thanks for having me here today. Another little bit of information that might link me a little closer to you guys is to let you know that I was involved with organising very early form of this kind of workshop at UQ, where I was working at UniQuest, a similar company to QUT Bluebox, about 8 years ago. So I get what you're doing, and I admire you all, and I'm glad that you're thinking about taking an entrepreneurial journey yourselves. I also wanted to make a comment. I came in the last 5 minutes of John's talk, and John is one of my heroes. He'd probably hate me to say that, but I really enjoyed the last quote that he put up on the slide. And I think I'd like to make a couple of points. The first thing is that there are many heroes in many walks of life, but even though it's an individual acclaim, heroes are backed by good teams. And I guess in the world of entrepreneurship, one of the members of that team, or one of the parts, one of the sub-teams, if you like, is the people that provide the financial resources. So I like to think of people that provide capital, like venture capitalists as hero enablers, if you like. The second thing is that I think we've got it all the wrong way around here in Australia, because our heroes are our sporting heroes by and large. Perhaps in some cases our performing artists, but very few of our publicly acclaimed heroes are people that build strong businesses to the betterment of the Australian economy. So I'd like to see that changed. I'd like to see the everyday person on the street acknowledge the efforts of people like John, who have created many, many jobs and contributed to making this a stronger economy. So that the hero analogy strikes a good chord with me. So I have a little slide here introducing myself, and I don't really want to talk to it other than to say that, like many venture capitalists, I've got a very diverse background. Most of my career, though the older I get, the less I can say that, but most of my career has actually been in the private sector. From a technology point of view, I'm an expert in plant biotechnology, which doesn't really help me these days, other than that I obviously understand technology, I understand the scientific process, and I understand how to take new technologies to market. I run a technology incubator. As I said, I've worked at UniQuest, and for the past 4.5 years I've been a partner at OneVentures. And I'll explain a little bit more about my role at OneVentures and what being a partner in a venture capital firm means, because I think it's really important in every partnership to understand what motivates the partner. And there's a little bit of a kind of a bad vibe out there about VCs, so I'm going to hope to explode some of those myths today. Hope. So I want to start off by saying that there are many, many different sources of funding, and I imagine you've touched on some of these, but if you haven't, you can take my slides away, and there's some resources in the back of my slide deck that you can look at. Obviously, very many entrepreneurs start with what the 4Fs, friends, family, fools and founders money, so you might put in some of your own hard-earned cash. Some people are lucky enough to have, mums and dads and Auntie Marys that might chuck in some money, or other friends. That's typically where people will start. There's also government grants, although goodness knows what's going to happen in the next budget to government grants, so I might just leave that there. Clearly angel investors, people out there in the community that have got funding to back companies, and you'll all know numerous examples of where that's happened. Venture capital, If you get strong enough, the bank might give you some money, and if you're really successful, then you might be able to go out to the share market. So I make this point not to explain the relative benefits of each of those funding sources, but just to say that venture capital is just one source of funding, and it's critically important if you are taking the entrepreneurial path to understand that venture capital is not for every investment, it's for a tiny minority, even though we talk about it a lot. Sorry, I thought I had taken the animation off this slide. Just let me make it all come up. So what is venture capital? Well, primarily what we do is provide cash to companies in return for shares in those companies, which is a fairly fundamental point, but it's one that needs to be made. So we become a co-owner of the company, generally for minority equity. So say an entrepreneur or an organisation starts off owning 100% of the company. Generally, by the time you first engage with a venture capital firm, you'll give away somewhere between 20 and 40% of your company for the pleasure of using their money. We usually invest at a very early stage, although there are different venture capitalists who invest at the seed end and others invest later. So if I talk about our funds, so our first fund was a $40 million seed and early stage venture capital fund, and most of the companies that we've invested in, not all, but most of them are at the post-proof of concept but pre-revenue stage. Now, in the 4.5 years since we launched that fund, the market's changed, and now there's a lot of incubators and accelerators and angel groups providing money in that part of the market. So our next fund is going to be later stage, where there's a gap, where many companies can't raise the sort of $5 to $10 million needed to grow. They'll go offshore, and we see that as an opportunity for us to raise a fund in that part of the market. Fingers crossed, it's not done till it's done. I say that venture capital is expensive. It's expensive because you have to give away equity, and in many cases control. So this is something to be considered. Where we get our return, if you think about buying and selling a house, an investment property, you're going to get rent along the way. In the case of venture capital, you don't get rent along the way. You only make money when you sell the house, if you like. So we're concerned about capital gain. And we're in it for a medium to long term. So typically between 3 to 5, 7 years at most. And part of the reason for that is most venture capital funds are structured with a 10-year life. So we have 10 years to get our money in and to get our money out. It's high risk. There are lots of statistics out there that say that if you make 10 venture capital investments, probably only one will be really successful for you. Of course, that's a generalisation, and some funds are much more successful than others in picking good investments. And because it's high risk, what we're targeting is massive returns on our capital. So say we put, for argument's sake, $1 million into a company. When we exit it 3 or 5 years later, we're going to be looking for something like $5 million, which sounds greedy, but I'll explain why it's important to aim for those hurdles a little bit more in a moment. Many venture capital funds, more so these days, provide a lot more than money. They provide a lot of management expertise, and again, I'll give you some examples, and they tend to be very hands-on. If I give you an example, at the moment, I work at least 1 day a week in one of my portfolio companies, so there's a big commitment of time. And if we're successful, we can offer our investors a high return. So this is a complicated slide, and I don't want to dwell on it, but last time I gave a similar talk to this, at the end I realised I hadn't really said enough about equity and the fact that there's an exchange of capital for equity here. So I wanted to just use this graph to visually demonstrate that what we're interested in is growing companies, and as a consequence of that growth, while the founder might own less proportionally, in the end, hopefully their stake is going to be bigger. So I'm not going to go into the ins and outs, it's just a visual demonstration of the fact that what we're doing is growing value to the benefit of all the shareholders. So let's just give an example of how OneVentures is put together so that you can understand how a venture capital fund works. So our job as venture capital fund managers is to make money for our investors, which I just want to let that sink in, because I think lots of times people think our job is, to help founders and, help grow companies. That's important, but our outcome is making money for our investors. Our investors want more money in this very high risk asset than they can get from, for instance, simply putting their money into the share market. So our job is to give them a return that's better than the market, because that's a compensation for risk. So we go out to our investor base and we raise capital into our funds. In the case of OneVentures, like many Australian venture capital funds, we started with a $20 million federal government innovation investment fund scheme. This is where the government has provided us with $20 million into our fund with the expectation they'll get that and a premium back. And then we raised alongside that $20 million from 35 high net worth investors. So these are typically people that have done well. They might be tech entrepreneurs like John, or they might be people who have just done well in business and have capital that they want to invest. This forms our $40 million venture capital fund. And because $40 million isn't really a lot of money when you're talking about high-tech companies, we've also raised a series of little small co-investment funds alongside that. Then we invest, obviously, that money into our companies, and you can see the logos of the 9 investments that we've made along the bottom. And our job is to manage those companies, to grow them, and then eventually to exit them to give a return to our investors. So that's, in a nutshell, how it works. So if you think about it, it's like, I always think it's like being in a big tug of war, because you've got your investors over there that you're responsible to, and then you've got your founders and your companies over here that you're also in a different sort of contractual relationship with.
Do you promise a minimum return?
No.
On investment?
No. That's why I say it's highly risky.
Risk, yeah.
Because there can't be any promises in this space. So you use best endeavours. And the fund's structured as a partnership. So our investors enter into a partnership with us, and then we manage those funds on their behalf. And they also expect us to invest individually in the fund as well. So they like us to have skin in the game. They figure if we're not going to work merely for them, then we'll add that extra incentive by investing ourselves.
So they don't.
Do you write a contract about this?
We have a whole series of contractual relationships with our investors, but our contract doesn't promise a return. Just as when you invest in the stock market, nobody's going to promise you.
Timeline, right?
Sorry?
Is there even a timeline then? No?
The timeline is the length of the fund.
Okay.
So our investors require us to get their money out within that 10-year period.
Okay.
I was just going to say, so the investors don't actually invest on the company, they invest on you and you handle the money?
Correct. That's right. So, and the money also, sort of as an aside, they don't just put it in the fund, then we pull it out. Every time we want to make an investment, we go to them and ask them to give us the next little bit of capital so that we can invest in the company. And then if you like, the fund holds the shareholding in our portfolio companies in trust for our investors.
And Marie, how much influence do the investors have on the kinds of companies that you choose to invest in? Are they part of the board? Or?
Okay, so the answer to that is theoretically none. The investment decisions are entirely made by the management company under an investment committee structure. And the investment committee is the 3 partners in the fund, myself, my partner Paul and Michelle. On a practical level, we invest a lot of energy trying to understand what sort of investments they'd like us to make. So we know, for instance, I'll talk about one of our investments, Access, later on. And we know our investors all love that investment. They see it's got great humanitarian benefit, great potential. It's an accessible technology for them. So we take into account their preferences, but they don't have any right to direct the way we place those investments. Clearly the evidence that they don't like what we're doing will be if they don't invest in the next fund. Yeah. But we talk to them and we make the decisions. Can you just tell me if I'm going too long? I didn't look at my watch, I'm sorry.
Absolutely fine, so far.
So I think this really just reinforces what I was saying earlier, that we have what we call our limited partners, are our investors, and we, the general partners, are the managers of the fund. So they contribute the capital, we contribute the management expertise to run the fund. And just a little bit about my partners who have got stellar careers. So in the middle of this photograph is Michelle Deaker. Michelle, very accomplished lady, but probably the most important attribute of her professional career that relates to her ability to have a strong role in our fund is that she established a company called Ecom Industries, which became the company that provided online gift cards to companies like Myers and David Jones and so on, that was eventually sold to a US entity for a large figure. Paul Kelly, Doctor as I like to say, because he's both a medical doctor and a PhD. Paul left a lucrative career as an endocrinologist in Australia to set up a company called Gemini Genomics in the UK, which by the time it was purchased by a US company was valued at about $250 million. So you can see that we are people that have actually been on this journey and understand what it takes. So again, this slide's got a lot of numbers, but I just wanted to make a point on this idea of internal rate of return, which some of you will be familiar with. I said earlier that if we place money within a period of 3 to 5 years, we want to exit at 3 to 5 times our capital. And that's because what we want to achieve overall for the fund is a rate of return of 30%. And obviously if some of our investments fail and some are successful, that means we're relying on one or two to pull us up to that rate of return. And this really is a number that reflects the risk that our investors have made in investing in this fund. Not a lot of funds achieve it, but that's the aspiration. So a very important point I think to make is that VCs do a lot more than provide money. So we provide our companies with the benefit of our own operational experience that we've walked in their shoes, if you like. We provide them with access to networks. So you can imagine with 35 extremely successful investors in our network, the kind of networks that we have access to on behalf of our portfolio companies, not to mention our own personal networks. Many companies, when they come to us, have been a sole director company, so we help them assemble a board and start operating and governing their company in a professional way. Obviously, we help them find an exit, and one of the contracts, if you like, that a company will sign with us when we invest with them is the contract that says that they want to drive this company towards an exit outcome. We help them recruit staff. If I give you an example, I've invested in a company called Chart Health in Brisbane that provides oncology information services to hospitals. So basically they provide the programs, the IT programs that manage the cancer journey of patients. I've just recruited a new CEO, I'm the chair of the board, just recruited a new CEO and 2 new directors to the board. We help recruit probably the scarcest resource in the job market at the moment, developers for companies all the time, and various other roles. We provide mentoring. We help companies raise follow-on funding. So in the example I was just giving, we're about to go out and raise another $5 million for that company. We help them with business development, a whole range of other things. So I hope I'm communicating the message here that it's not just about capital, and most investors won't just hand over money and walk away. They'll want to have a role in shaping the company and trying to create that value.
Can I have a question?
Please. Yes.
About the board governance, can you please just a little bit expand this? Because
So
this is my field.
Sure. So as I gave in my example, many companies, even Charm Health, when we invested in them in the first instance, even though it was a company been around for 7 or 8 or so years, had a single director who was managing all of the governance of the company and was not well equipped to be able to provide all of that support at a board level that the company required. For instance, strategic development, management of all of the compliance or regulatory issues that a board provides, and financial and fiduciary management of the company. So the first thing that we did when we came on board was we structured the board appropriately according to AICD good governance principles with the founders, the investors and independent directors. We started running good management reporting processes, so that every month management would report on the financials, on the sales pipeline, and become accountable to the company through that board structure. And that's quite typical with these companies. Does that answer your question? And we'll talk about that one for another hour. So, just to conclude, I just want to make the point that there's a lot of competition for a very little amount of capital out there, and you've probably got a sense of that already. And it's really important that if you are ever going to seek capital, that you're as well prepared as you possibly can, because you really need to make sure that you tick all of our boxes. Investors are busy people, and lots of people are looking for money from us, so you want to make a good impression right at the outset. Just to give you an example, I said earlier that OneVentures has been established for 4.5 odd years. In that time, we've logged 1,200 opportunities, and as I said earlier, we've invested in 9. So how do you get from being one of the 1,200 that makes a phone call to us to one of the 9 that we invest in? You do that by being very well prepared, by, if you're really serious about raising capital, getting a warm introduction to the investor. I will always pay more attention if, say, for example, John was to say, I'd like you to talk to this company, they've really impressed me, than I will if I just get a word inquiry or whatever. And by fulfilling the criteria that the investment manager is looking for. So let's just talk about those. Come back to these slides in a second. So what are we looking for? Well, this sounds really hackneyed, but every year that goes by, I believe in it more. What you invest in is people. I mean, on the assumption that there's a good idea and there's a market problem that the idea is going to solve, and you can develop a business model. The people are what executes that idea and adds value. So we're really looking for people with passion, people that are capable, people that we can work with, and that's the most important tick box in an investment. We're looking for large and growing markets and people that can do more than kind of say, you know, I did a bit of Googling around and I reckon the market's X. So looking, you probably cover market research. So having really good sound market research, having had conversations with prospective clients and being able to talk knowledgeably about the market is really important. Having a good plan about how you're going to realise the value in the company is tremendously important. And I'm not talking about writing a business plan this thick that you throw on the shelf and nobody ever looks at. I'm just talking about knowing where you're going and how you're going to get there and being able to document that and explain it. I imagine most of you considering a career in entrepreneurship are technology entrepreneurs, so having barriers to entry, things like IP protection is very important. Being able to demonstrate how you're going to make money out of your idea, I mean that's the end game, that's where the value lies. And we investors, as I said earlier, are hands-on, so we want to be able to see that we can add value. If I was to invest in a company in a sector that I knew nothing about, I would probably be able to add very little value. So we're interested in making sure that we can add that value. And then obviously showing us how we're going to get to an exit. Who might buy your company eventually? What sort of multiples are people getting out there in the market and so on. So just to tie off, there's more information that I can cover. I just want to give you a couple of examples of the sorts of companies that we've invested in. And this first company, The Best Day, is probably has a founder that's a little similar to many of you in the room. Whitney Comore, the woman on the right of the screen, is a University of Sydney graduate. She's had only 1 or 2 years experience in the workforce, and she came up with an idea to develop does anybody here use Doodle for meeting planning? So I would say that Whitney's planning tool is Doodle for social, a way of planning events with your friends. which doesn't sound all that exciting. And, you know, we get people coming through the door with that kind of stuff all the time. The thing that made Whitney really stand out is that when she came to us, she had multiple points of introduction. So she's an amazing networker for someone in her mid-20s. So people kept coming to me and saying, you must look at the best day, and eventually I had to listen. She'd also done an incredible amount of market research. So when I was doing my due diligence, I went along with her to the people that were going to be her clients and listened to them talk to me about how they thought this product would work for them. Because in the end, this is actually about making money for businesses. She also had, interestingly enough, invested some of her own capital, and that demonstrated to me that she really backed herself, and I thought that was really impressive. And she had really good documentation, really good presentations, a really nice business plan, and really good collateral. So all of those, you know, I could ignore all those elements of the fact that she was relatively inexperienced because she had just done such a tremendous job of presenting her opportunity and demonstrating the value that she could create. And she's a wonderful person to work with. I really enjoy working with her. At the other end of the spectrum, this is one of our investments in Queensland, Vaxis. It's a University of Queensland technology. And the technology behind Vaxis is a new way of delivering vaccines. So rather than the needle and syringe, this is like, looks for all the world like a little silicon patch that's got tiny little invisible nano needles onto which the vaccine is coated, and then it's applied to the skin and the vaccine enters through the upper layers of the dermis. Very exciting technology, not just because it does away with the needle and syringe, but because potentially it does away with cold chain. So it means in countries where refrigeration, for example, isn't very good, you no longer have to have really efficient cold storage of the vaccine because it's a dry coated product. So we led a round of investment of $15 million into Vaxis. What really attracted our attention here, and obviously it's a great story, you see great stories all the time. The scientist at UQ who developed this idea is incredibly eloquent, and he had a great way of telling his story and his aspirations for what this technology could do. The university was backing it strongly. It was really well packaged, and it was, you know, virtually from the first meeting we knew we wanted to invest in this company. So I think there are two examples that give you a bit of an idea of either end of the spectrum of our sort of investment portfolio. I won't go through this, you can look at that later. So to close off, what do we not like? VC is not for lifestyle businesses. It's not for creating a little company that might employ you and 5 or 6 people. Perfectly valid business model, and it's what most Australian companies are, but VC is looking for that spectacular growth. We don't like the hockey stick, outrageous, unsupported market and projections that don't have good assumptions. Give me a hockey stick, I'm happy to see that as long as you've got great assumptions that support it. You need to learn to communicate your idea to us succinctly, and I'm sure that's something that you're going to be focused on in this workshop. So, you know, getting that 30-second pitch right, getting your 10-minute pitch right is really important. We like to invest in companies that want more than just the money. I think I've laboured that point. We often have investee companies coming to us saying, that's not how they do it in the valley. So I use this as a metaphor for, you know, we are who we are and we invest as we do. You know, you partner with us on our deal terms or go somewhere else because we all have valid reasons for putting our partnership documents together. And I use the word partnership advisedly because if you do accept money from an investor, it is a long-term partnership. I think it's more like a marriage really than a contract. I guess a marriage is a contract. And we also like our portfolio company CEOs to understand their financials. You know, in the end, it's going to be about money. We want to know that you can competently manage the money that we're giving you and that you can drive the company forward on a value basis. So I've sort of summed up my points there, and you can read them because I'm sure you've got the slide deck. But I think most importantly, as I said, accepting money from VC is not for every company. VC money is very scarce, so you need to understand how to present yourself to be successful, and bear in mind that when you accept funds from a company like OneVentures, it is a long-term relationship. We've got to like each other, we've got to work together. So you want to invest as much time in making sure that that partnership's going to work for you as in every other aspect of due diligence. I think I'm done.
Any questions for Anne-Marie? Or Jerry? I'll actually just start by adding a comment, which is to say I liked one of your points, Anne-Marie, when you spoke about the role of the VC being also for iteration and consolidation, because it's inevitable, I think, in the high-growth business there are going to be roadblocks that can be stumbled on the way. And I think that the real value can often be added not on a day where the business is going really well, but on a day where there are some challenges ahead. And you've got a team of people and partners around you that help you overcome those issues, often in creative ways that you individually, as an individual founder, may not have ever dreamt of or have the context to do.
You're quite right, and I mean, in any company, the role of the CEO is very lonely. What a good board and a good investor does is provide a sounding board for the CEO and the senior management during times that are hard, and as you say, celebrate as well. I think celebration is very important.
Yep. Any thoughts or comments or questions? You've all got 6-minute pitches coming up later this afternoon, so anyone wanting any tips from Anne-Marie on how to get the best out of your elevator pitch?
Well, can I ask you what you've been advised should comprise your 6-minute pitch? Can anybody summarise what you've been told you should cover in 6 minutes?
They've each been given case studies and told who they're pitching to.
Right, so it's not always investors?
Not always, no. Typically it's to, well, it could be, it's to, in some cases, to companies that could be licensees, or that could corporately take an investment into a new startup. So.
Gee, you're going to do great.
We don't want to give away our secrets yet.
Okay.
Well, on the slides, this is, like one of them, what is discuss, like, what is the problem?
Yep.
And what is the solution?
Yep.
And then, what does the market look like?
Yep.
And commercialization pathway. And what is the business model? Who are your competitors? What is your IP strategy? And then what are your future plans?
Okay, I think that's
So kind of cover those type of things.
I think that's great, and it sounds like you've covered. There's something big's missing there.
Oh no.
What?
Well, what was the thing I said was most important?
With your team.
Yes. Yes. I don't think you said that. Did you say anything about team?
No, but I guess we each have, roles.
Yep.
And
Okay.
so I guess that will be in our introduction.
Okay, good.
But
That's a good start.
awesome.
I was going to ask, when someone's pitching to you,
Yes.
do you like to be buttered up a little bit first before they ask you for the butter? Or do you prefer to come out straight away and say, we like $1 million?
I don't know how to answer that question. I've never been asked if I wanted to get buttered up before.
So yeah, gently, or do you like, I need this much and this is why?
I think that your point generally is well made. It's important to tell us how much funding you want and what you want to use it for. So, I mean, there's no secret here. The reason you're pitching me is because you want money. So buttering up's probably not going to help. But the best form of butter up is that you've actually done some due diligence on us. So if I give you an example, there are many venture capital funds in Australia that only invest in life sciences. So if you come and pitch an IT deal to them, it just goes to show a complete lack of interest in what the investors' preferences are. So I think the best compliment you can pay to an investor is actually to have done a bit of due diligence on them first, to understand how they invest, what sort of things they invest in, and demonstrate how your proposition can fit into that portfolio. So I guess that's buttering up in a way. John, did you want to say something?
Well, it's a similar question. If someone's pitching to you, and I don't mean for this afternoon, I mean generally speaking,
Yes.
And you mentioned earlier about market research and market analysis versus business case. Do you try and evaluate the opportunity, i.e. the market opportunity, or do you try and evaluate the business model? Like, where do the two fit together?
Well, I think both, because typically the people's analysis of the market, the size and how much they think they can actually access of the market should flow through into their projections around business models. So you put together good market analysis, a good business model, and those are the assumptions that flow into the financial projections, which drive value in the end. So I think it's important to have all those linked. But I personally get very frustrated with entrepreneurs that come and haven't put any thought into business case, because it's important to have a problem and to be able to quantify it, it's important to have a solution, but you have to understand, for example, just use an example, at what price does someone need to buy my solution to make my business profitable? The world's full of people, you can sell anything at a price, but if you're not going to make a profit, it's not a business. And I know I'm making generalisations, because many of you will be working on solutions that perhaps have a licensing outcome. So it's not about profitability in the sense that I'm giving in my example, but you need to be able to show how you can drive the business model.
Just to add to one of Anne-Marie's points earlier about understanding the investors that you're pitching to, and Anne-Marie was saying this much more than I have, but it always amazes me how the people who are considering the capital raising process, how they're paying very little attention to what's the ultimate exit strategy going to be, and then you're thinking, put your investors in the time frame you're in, how they're going to exit. And typically the response is, oh, we're going to list on the stock exchange. And I don't know what their current figures are, but I think a few years ago it was about 1 every 10,000 exits were listed versus typical acquisition fund.
Yeah.
So again, really giving thought to what that exit's going to be. If it is an acquisition, understanding who are the target acquirers, what stage of the business cycle are they at, what are they actually looking for, what are the gaps, etc. Is that typically how they bring in new technology, is through acquiring a company where they typically licensing? So understanding that dynamic probably is quite important. I'm sure you agree.
I do, and I think it's also really important to note that a listing, an IPO, is not always a good exit for an investor. So I did a listing about 4 years ago of a company that listed at $1 and is now worth 12 cents. We didn't actually invest in that company, and I hope it will recover. I have high hopes for this company. But as an investor that may have had to get my money out within that period, I wouldn't be really impressed with an IPO as an outcome. So I actually reinforce what you've said there, in that if you can come to me with a list of, I don't know how much it would be, but this is the sort of company that might acquire me one day. It won't necessarily be the ones you list, but that's a really impressive way to approach an investor, that you've actually started to think about where the end game is, and you can give us some ideas around what that might look like. So it's like the icing on the cake if someone's done that when they come and pitch you.
Another thing I was going to raise too, Marie, just to expand a bit on the comment you made, totally agree with the early stage investment space has really rapidly advanced, which is a great thing in Australia in the last number of years. Did you want to comment on some of the emerging areas like equity crowdfunding and certainly, I guess, more so on the accelerated model, where even certain likes of Blue Children now that are almost putting in a sweat level of input for their equity, not just their sidecar fund. Any general comments that you wanted to make on that? Or?
I think two general comments. I think the reason a lot of these incubator, accelerator, early stage models are working is that the price of establishing and driving an IT startup has reduced dramatically over the last few years, and there's a whole lot of reasons you're probably all aware of. But that sort of takes me to the point that those sources of funding aren't for every sort of technology. So whilst they will work well, for instance, in many of the IT plays that you'll see these days, they're not going to work for a biotech investment. So, it's sector specific. The second point that I'd make is that I think all the money that can be around is great. So I think if we can get a crowdfunding model up in Australia that works, I think that's brilliant. The more incubators, the more accelerators, the more angel groups, the better. We need all of those elements of the market to make to build a healthy ecosystem of investment here in Australia. However, it's not the same investment instrument, and I think that's something that's not discussed a lot in the debate. So we hear a lot about the accelerator model, and it's important, and I support it, I think it's wonderful, but there's still a requirement for those later stage, bigger leaks of capital, particularly for clean technology, life sciences, robotics, those kinds of plays where it's not a few $100,000 that drives you through to success, it's a few million or a few tens of million. And I don't want to see those sorts of companies go offshore. So we need to build the later part of the ecosystem as well.
When I mentioned the word crowdfunding, does everyone know what that's about? Is there anyone? Well, the crowdfunding model typically started off on the basis of people actually investing in a team that wanted to bring, say, a new product to market, and their return was actually getting on the first products that came out, so they weren't actually getting issued equity in the company they were backing. They were really backing that new product, if you like, and that's sort of expanded out to a lot of social enterprise now as well. There's a move afoot for that same funding mechanism to now convert to equity, so you're not actually getting the first product that comes out, you're actually backing a company and getting a small amount of shares in return for your investment. I guess one point that strikes me with that model, and we're still playing around in Australia with how that might scale up. It's 3 or 4 players now in the high net worth space, but not quite reached the retail investor level. But one thing that strikes me in there, which is sort of a real point of difference with how the traditional VC model works, is the fact that we're starting to get towards a money-only play with that, and that level of rich advice and partnering seems to get lost a little bit in that particular part of investment. So.
Yeah, I think that's a really valid point that the real venture capital model is that you have a responsible manager of your funds, and the crowdfunding model removes that responsible manager role, so it becomes much more of a hunt. That's okay.
Yeah.
People are prepared to pump their money on an all-care, no responsibility basis, but that's well and good.
Yeah.
But this is the reason why the government is so interested in legislation around this space, to protect the consumer, the retail investor, I should say. Yeah, I think you make a very valid point. But, you know, if I'd known about it, I probably would have invested in Kate Miller-Heidke's new album, got a free album. You know, it's interesting how it's unwrapped, hasn't it?
Yeah, it is actually, in a very short space of time. So. Any other questions, Graham, while we've got this?
Is there any opportunities for the postgraduate students apply for funding? Is not only for the government funding?
For funding from OneVentures?
Funding for our research, or maybe for the research.
Well, most VCs invest post-research, but of course, you can be anybody. And you're welcome to apply. What you need to do is understand what sort of companies we're investing in. And I just want to clarify, because it's not a grant, it's not government money, it's a fund. So you apply for funding from the entire pool, and anybody, regardless of age, experience, technology, as long as they meet our criteria, can apply for that funding. So yes, the answer to your question is yes.
So typically, as we sort of ran through our last day or so, where Woodbox often plays a role, and that is looking at the outcomes of research as they come through, and then understanding the gaps that often exist at that point before we can get to a point where something like a OneVentures, probably fund number one, also, be interested in having a look. And then, many occasions where we wouldn't actually get through to that point of actually putting in the favour down because we couldn't satisfy ourselves that there's actually going to be a point that would be of interest. And again, we try to reserve a few times that we do pick up the phone to those that are well established and are going to meet those objectives. But often, as we mentioned yesterday, there's a gap in between, which is what Anne-Marie referred to as proof of concept, where the research might have been, for the most part, completed, but there's still a number of elements that need to be done in terms of doing some comparative testing, building a prototype, getting into early stage animal models in the case of life sciences, where we can really then get through to a point where we can demonstrate to ourselves as much to external potential partners what the opportunity is. So we have a fund for that. In Bluebox, Martin Slentz, who spoke earlier today, is a recipient of some of that funding, which you heard. But there's several other projects that we've invested in, and as John Puttick and I were mentioning before, sometimes those early stage investments, internal investments, actually end in failure. But we don't often see that necessarily as a bad thing, because we've been able to find that quickly, fast value if you like, and then allow the research program to take other directions in many cases to look for more promising leads.
And just to give you a bit of hope in answer to your question, one of our most successful investments is a company called Smart Sparrow, which works in education. It's a field called adaptive e-learning. So they develop tools, for instance, that allow you to do a simple chemistry experiment online. Very, very cool technology. And Smart Sparrow was founded by a University of Sydney PhD. Was the first thing he did post-PhD, and it's based on his PhD research. They just raised $10 million. So you can see they've gone, in the 3 years since we first funded them, they've grown into a really significant business. And he had not worked, he basically did his PhD and came out and founded that company. It was very successful. So it's all walks of life and all
Good
levels of
example.
experience.
Yeah, that's excellent. On that high note, we might, if we could please put our hands together to thank Anne-Marie.
Okay guys, so you actually don't have long after lunch to practice and prepare your pitches for the afternoon session that starts at 3. So I'd suggest taking this time to formulate your pitch properly, and then use that hour as much as possible to practice it as a team, so it looks pretty slick when you're doing a pitch. We'll just go through some of the tips that we have for you. So again, hopefully by now you have come across or looked at all of these considerations. Again, the team, I guess, for you is talking about the research team or the team that you have in your case study. If you do want to focus on that, it's probably a good idea, but there's not really much background in the case studies on these fake researchers. So it's, yeah, if you want to make up a backstory, then feel free. So who are you pitching to? What is the problem, solution? What does the market look like? What's the commercialisation pathway? Business model, competitors, IP strategy, and what are your future plans, including your budget? So how are you going to, how does it fit into the company's portfolio or the investor's portfolio was a key thing that came through with Anne-Marie. So just, I think by now pretty much all of you have got those points. I've seen a lot of you have that. So just use the time now before lunch and the time after lunch or even during lunch to work on your pitches together as a team and start practicing.
Got a bit of work to do.